Okay. U.S. mutual fund classifications. So we have examples here of investment funds by classification, what their assets, what the total assets are. You can see the assets in billions. This is just an interesting table. It doesn't necessarily tell you how to invest or not to invest or anything like that. It just kind of shows you where people are generally putting their money more frequently. And this will shift based on not only local and macroeconomics, but also global economics. It's when you'll see risk, people becoming more risk averse as the economy is poorer, and becoming more open to risk usually as the economy is doing better. Okay, now people who deal in mutual funds and people who are responsible for choosing what goes into a mutual fund don't do the work for free. It's not an important point that I don't know that I saw well enough put into this chapter is that when you work for one of these mutual funds, there are different types of individuals, and there's something that's pretty recent called fiduciary responsibility. And if an organization or an individual has what they call fiduciary responsibility, that means that they are legally obligated to make the decision that they believe to be best for the investor, regardless of if they are receiving fees or commissions from one end or the other for buying and purchasing blocks or sales and things like that. So if someone has, if you're trusting someone else with your money, you want them to have what's called fiduciary responsibility, because that means that they are making their best guess as to what the best decision is for you, the client, with no bias, or intentionally no bias for themselves based on commissions or other things. So different types of fee structures. Operating expenses are costs incurred by the mutual fund and operating the portfolio. So this is everything from paying the employees to anything that has to be done if there's commissions or fees that have to be paid. A front end load is commission sales are charged when you buy the shares in the first place. So this would be if I'm going out to buy shares in a mutual fund and they say, okay, but we charge a 5% fee, and they do it right then and there, and you get 5% charge right then. You shouldn't have, if it's only a front end load, you shouldn't have fees on the back end. Whereas the opposite side of that, a back end load, well, they charge, a given percentage or some sort of commission or fee, would be the opposite. They don't charge you anything to get into it. They charge you to get out of it when you exit the fund. 12B1 charge, and that's just named based on the law that caused it from the SEC. It's annual fees charged by mutual funds to pay for marketing and distribution costs. So it needs to be reported is what that 12B1 did. So how are fees different for classes? The Dreyfus Yield and Fund in 2017. Notice the trade-off between front load ends and 12B1 charges in Class A versus Class C. So front end load, we got 4.5% in Class A and only 0.25% for 12B1, so my expense ratio is 0.7. Notice in Class C, we've got the exact same expense ratio, but it's a back end loaded at 1%, and the 12B1 fees are much higher at 1%. So obviously this depends on the size of the investment. Load is lower for investments above $50,000. So as you might expect, fees are on a scale, and the more that you choose to invest, the less they're going to charge you. The less they're generally going to charge you. All right, fees, load, and performance. Gross performance of load funds statistically identical to gross performance of no load funds, which, if that bullet point is correct, and I believe it has been for a long time, that implies you should always be looking for no load funds. Because why would I want to have load and commission if there is no statistical difference between gross performance from a loaded fund to a non-loaded fund or a no load fund? Fund with high expenses tend to be poor performers. 12B1 charges should be added to the expense ratios. I think sometimes they try and show you without the 12B1 expenses, and I think that's what the point the book is making here, is that if you include the 12B1 ratios, then you're getting that statistical difference of very little to no difference in performance on no load funds versus loaded funds. And you can compare costs with Morningstar, and we've used that. There's also, what I mentioned here, hopefully you're watching the videos, if you log into Newman's library, there's also something on there called Emergent, and that is a database that we have where you can do a lot of comparisons, and you can look at a lot of stock transactions and equities and funds and things like that. So I also recommend looking at that. All right, net asset value and effective load. The cost to initially purchase one share of a loaded fund if it's a front-end load, is the net asset value plus the front-end load, if there is some. Stated loads typically range from 0 to 8.5%. That's a really high load. Paying almost 10% for load up front seems pretty hefty. Load is designed to offset marketing expenses. Marketing expenses, we're talking about selling the product, trying to get people to buy into the funds. It goes to the broker who sells the fund to the investor. The effective load is greater than the stated load. Fees and mutual fund returns, soft dollars, the value of research services brokerage houses provide free of charge in exchange for business. So the rate of return, we have our net asset value at the end, that's what the sub 1 is, versus our net asset value at 0.0, which would be when buying in, plus income plus capital gains distributions all over net asset value at day 0. Again, that would be when you buy into the fund in the first place, gives you your rate of return. So this is a fund. Fund A is a no load with 0.5 expense ratio. Fund B is no load with a 1.5 expense total expense ratio. And Fund C is an 8% load and a 1% expense ratio. So this is just showing you basically the time value of money and that the gross return on all funds is 12% per year before expenses. So you can see that in Fund A with a no load and a 0.5% expense ratio, you get substantially more money with the same, we're assuming, they've made the intentional assumption here that they are taking a 12% return on all of these, Fund A, B, and C. Notice that Fund A and B, because there's no load, no front-end load, that it's the full $10,000 investment, whereas Fund C, they take out 8% of it, and that is a major contributing factor to the growth. But also notice that front-end load does better, in this case, with the numbers being used, than Fund B does at the end of 20 years. But both of them are dwarfed by Fund A, with all else being equal. All right, general tax rules. A fund not taxed if diversified and if the income is distributed. The investor is generally taxed on capital gain and dividend distributions. And the turnover ratio of trading activity to asset portfolio. So turnover is just how much trading activity how much are they trading? It's how active they are more than anything else. So how much are they trading based on what the actual assets are? So if it's $100 million worth of assets and they're only trading $1 million on a regular basis, that's a pretty low turnover. But if it's a $100 million mutual fund and they're trading $50 or $60 million on a regular basis, say monthly, then that's a very high turnover rate and they are being substantially more active in their trading. Portfolio turnover may affect the investor tax liability because when there's more buying and selling, that can have tax implications because they can be taxed on capital gains and dividend distributions. So the higher the fund turnover, the more likely that there is higher tax cost. The implications of fund turnover: fund pays commission costs on portfolio purchases and sales, so we could increase our average expense as well, charged against by net asset value. Turnover rate is measured in the annual total asset value bought or sold a year divided by the average total asset value. Okay, exchange traded funds, ETF. Offshoots of mutual funds that allow investors to trade in index portfolios. I believe these were kind of started around 1993, if I'm recalling correctly. The advantages to an ETF is they can trade continuously throughout the day. They can be sold or purchased on margin, which generally mutual funds most often cannot be. Potentially have the potential for lower tax rates and lower costs if they have no marketing or lower fund expenses. Potential disadvantages: small deviations from NAV possible, and there's oftentimes a brokerage commission to buy, which effectively means it's front loaded. There's a potential disadvantage to an ETF and an exchange traded fund. So this is figure 4.2, and it just shows the change in sector and how much is being invested in the different types of mutual funds. And you can see that it's really varied over the years. You can also see that when the recession starts to hit, you see a big jump. You see a lot lower jump in equity and a lot higher jump in global international. This was the U.S. Recession. And so you see people jump and shift. This is effectively showing the jumping ship from U.S. funds to more international funds. And you see that happens. That usually has an indirect correlation with the economy, the U.S. economy specifically, if you're talking about global, international versus U.S. equity sections. Investment company assets under management in billions of dollars. You can see the vast majority is mutual funds, and exchange traded funds is the second. Closed-ended and unit investment funds are a very, very small percentage. The vast majority is exchange funds and mutual funds. Now, that's still a lot of money, dollars and cents wise, but it's not a lot of the total market. The average mutual fund performance is less than the broad market, which is interesting too, because that's telling me that why am I paying for a mutual fund to handle if the broad market is doing better, which really doesn't make a whole lot of sense. So this is a rate of return on managed equity funds versus a Wilshire 500 index. So this is comparing an index specifically to the returns. And the blue is the Wilshire 5000 and the active funds. Now, what's funny is the active funds are talking about active trading, because obviously with an index fund, you could have a Wilshire 5000 index fund. They're specifically talking about funds that are trading on a regular basis and trying to basically, effectively, they're trying to beat the market. That's what you want to call it. So evidence suggests that some persistent and positive performance over certain horizons. So the McHale study in the 1970s, but the initial period performance in the 1970s, the top half had a 65.1% return compared to the bottom half, which had a 35.5% return. But what's also interesting, if you go back to the other chart, is you'll see that generally speaking, every time there's a positive return, I shouldn't say positive return, a positive change, there tends to be a drop in the next. And this table holds true to that as well, where you can see that if performance were purely random from one period to the next, there would be entries of 50% in each cell at the top or the bottom half. Okay, but there's not. Okay, there'd be exactly 50, which is more like the 1980s study. Because bottom half and top half would be equally likely to perform in the top half or bottom half. On the other hand, if performance were due entirely to skill with no randomness, we'd expect to see entries of 100% on the diagonals and 0 on the off diagonals for the bottom half and top half. In fact, panel A shows a 65.1 of the initial top half performers in the 1970s fall into top half sample in the following period, while 64.5% of the initial bottom half performers fall into the bottom half in the second period. This evidence is consistent with the notion that at least part of the fund's performance is a function of skill as opposed to luck, so that relative performance tends to persist from one period to the next. Different areas you can find sources of information on mutual funds and different options for mutual funds. And I think that's it for chapter 4.